Hey guys, it's May from Markets with May. And in this episode, we're going to talk about the Activision Microsoft. It's a bit of an update from a previous episode. And specifically, we're going to talk about a couple of option strategies that I saw this last week that I thought were very interesting because it's very rare to get opportunities to talk about this strategy and where it might be relevant. And that essentially is butterflies. Butterflies, actually, there's a lot more opportunity to use it. But and iron butterflies, which rarely I think comes up because you really do need a price to pin it at. Okay, the disclosures: past performance is not indicative of future returns. I definitely have a position in Activision. If anything, I have been watching this deal fairly closely. So what I'm going to do format-wise is I'm just going to review some of the details of the deal as to where it sits right now. I'm not making a call either way, and quite frankly, it's a legal case, right? So this could turn south or this could close up very quickly. But we'll go through that very briefly and then we'll just talk very briefly about these two strategies. Specifically, I'm not going to go through all butterfly options, how to think about them and what they are. Really, this is a use case episode, and we're just going to go through the long butterfly option that I know for a fact because I can see it in the open interest. But I'll go through what most people have on. Okay, cool. Let's get into it. I'm going to share my screen. And as we know, well, let me go through some of the basics. As we know, Microsoft gave a bid to buy out Activision. It's been almost a year now. It's been the most painful year as far as that goes. And that deal was supposed to close pending any FTC or CMA issues, let's call it. And the CMA rejected the merger, and now we're right now going through it with the FTC. And what specifically it is that while pretty much every other country's approved it, the UK and the US actually have Microsoft being the larger market share. So it's a little bit of a different animal in the US and in the UK. That said, there's a lot of smack talk on Twitter that I'm not going to get involved with. But these are the articles that you can read up on if what you really want is background on what's going on. There was an article in Fortune. That one I think was a little less biased. It talks about the fact that it's a 68 and change. So they call it a $69 billion takeover, but it's like 68 and change. It's at the $95 mark. Corley will decide whether or not to grant the FTC's request for a court order. And if he decides not to, then Activision is free to close. And this thing rolls all the way up to 95, like more or less in a heartbeat, because the only other thing that would then exist thereafter is whether Microsoft wants to pay the $3 billion. Well, they're not going to pay the $3 billion penalty if the FTC allows it. But whether or not they want to wait to try to settle with the CMA, that would be the only thing that might delay it. And then there might be a little payment associated with extending the deal. But that payment's going to be a lot smaller if the FTC is thumbs up. And then as you can see from the New York Times, which also had a competing article with Fortune's article, if the FTC is like no dice, then Activision's got to think really long and hard about whether or not it wants to continue on with the deal. What would happen is that the next step, if the judge decides in favor of the FTC, is that you would have a court case in August the 2nd, where you have almost what they're saying might be a 3-year drag out of this scenario, and that for Microsoft seems like a nightmare scenario as it relates to this little acquisition. And there's various emails and documents that suggest that they don't care if they lose the $3 billion payout. Okay, so that's the economics of it approximately. Let me just make sure, let's see what we got. So guys, feel free to ask questions as you go. I usually take them at the end, but to the extent that they might be relevant for something I'm missing in this deal, that is cool. So a couple other things that I put down here. This is all cash. So as far as mergers go, it is a little bit different because we know there's no relative value trade between Microsoft and Activision. It's $95. That is what it is. That is what Microsoft is going to pay, no more, no less. However, if they pay the extension fee, and this is where it's gotten very exciting for the options market. But if there is an extension fee, because either something happens in this current hearing that makes Microsoft still want to go to trial despite having said that to the newspapers. Or alternatively, if they pay the extension fee because they want to wait it out with the CMA, then there is an NYSE rule. I believe it's an NYSE. It might be a SIBO rule. Don't quote me on that. But there is a rule that essentially, if the dividend payment, if a company makes a special dividend payment greater than 12 cents per share, you have to remark all the options. And so for a while, that had the options trading really nutty because it would imply that that dividend would mark down all the 95 strikes lower, meaning that you'd have to recast whatever your strategy was for the spread between wherever you think that, whatever you think the extension fee would be if it was issued as a special dividend. Right now, it's a little bit of a nuance and a weirdness because if Microsoft is saying, hey, if this doesn't go, if we don't get this through the jury now, sorry, I think where it gets a little dicey is if there's no, if extending this is off the table for Microsoft, then you're really just left with that 95. And then if the judge goes one way, deal breaks. If the judge goes the other way, deal closes. And so you had throughout the week a lot of people coming out of the options market in a strange way with that little tidbit of news flow that happened, even though I'm sure that the journalist writing it had no clue that that's why the options market was doing its crazy nonsense. Nonetheless, it does simplify the math quite a lot. And then from there, the other things to note is that, you know, if the deal breaks, then Microsoft pays $3 billion. And at the end, I'll go through what the economics look like for Activision, because for a while, some folks though thought for sure if the deal breaks, Activision is trading down. However, you have a couple of new things. You know what? I'll go ahead and show it now. You have a couple new things that have happened, not the least of which is the increase in interest rates has actually driven the overnight rates to such a point that you can get in both CDs and money markets, you can get a 5% rate on cash. And so here's the economics of what that ends up looking like for, for this slide that came out of the 10K is super relevant for Activision, because if you look at it, you can see all of their debt, which is 3.7 billion. Okay, they already have 12 billion in cash. So 3.7 billion of that cash comes from debt. I mean, you can kind of think of it that way. It's not perfect to think of it that way, but that debt is at 2.87%. And as you know, that we've been talking about markets with Meg all along, that the fact that you can borrow, or you borrowed and stabilized your cash at 2.87% on debt, but you're actually borrowing at, or sorry, you're receiving a deposit rate of 5%. That is just pure profit for your company before it does literally anything else. So that, plus the fact that the 3 billion comes back as cash, creates a very interesting scenario for Activision if the deal breaks, such that I'm not convinced that people have thought through this all the way. There are a couple of notes that have been put out by the broker dealers that have raised price targets, but some of those are dependent on the deal going through. And then you have the actual valuation of Activision. Last year was kind of a weird scenario. Trailing 12 months net income is $1.86 billion, which means it's trading about 36 times trailing. But it's really important to understand that the last 12 months were really bad as far as earnings go. They were about half the earnings of the previous year. So if instead, which it looks like is happening, if instead the games coming out late result in kind of an upside, plus the deal breaks and now you have 15 billion in cash to spend on whatever it is you want, then you're in a kind of a weird spot if you think that this company, which is trading about the same as, you know, Electronic Arts and Take-Two, but has like 3x the cash. It's kind of an awkward scenario on valuation. And that is why this thing is trading crazy these days. And it's very small and minimal in the cash markets, but it's crazy in the options market. Now, that then gave a bunch of folks an opportunity, depending on their point of view, to consider an iron butterfly. But we're going to go through a butterfly by itself first, because this was the opportunity that happened when the deal broke, or when originally the CMA rejected the deal. So a butterfly, a long butterfly, an out of the money long butterfly. Let me say it that way. There's probably other ways to say it. But essentially, you're buying a butterfly, which means above where the at the money price is. So right now, if you look at my screen, you can see this is just a screenshot of what I took earlier in preparation for this. But let's say it's $83.90. By the way, this butterfly, this economics does not exist anymore because that's already been arbed out. So this is kind of backwards looking, but you can watch it and monitor it over the next 2 days, because Lord knows that it may actually show up again, depending on how crazy these markets are. But let's say the price is $83.90, right? So you are going to choose the strikes relative to deal price, and you can choose whatever expiration you want, because the crazy thing that happens when you have a deal with a very known date of when it will collapse, you basically, the time value component, even though the options market makers are still going to calculate that a certain way, because the deal has not, because there's still uncertainty the deal doesn't happen. Essentially, if you believe the deal is going to happen, all of that in the future collapses right down. Okay. Because you're thinking, hey, this deal closes potentially by the due date, which is July the 18th. So again, if the deal doesn't close by July the 18th, Microsoft has to pay a penalty. If the deal breaks, they pay $3 billion. And then if they pay the $3 billion, then all of this becomes kind of a crazy thing, which we'll talk about next. But essentially, if you believe the deal 100% is going through, one of the things that people did was this butterfly. And in particular, during moments of extreme volatility, which happened such that the price is going especially if the price is going down dramatically, these butterflies, they have two components. They have both a direction and they have volatility associated with them. But the directional component, the delta coming straight out of these butterflies, will make these butterflies dirt cheap, which is what happened when the CMA announced. And so a lot of people got these butterflies done at 20 cents. The max loss on a long butterfly is the premium you put in. It's that 20 cents, okay? The max gain is the spread between the wings. In other words, this butterfly, which is done at 90 by going long 190, selling short 295s, and going long 100, all in the same expiry. The max gain is 500, which is the spread, the 5-point spread, 500 minus the premium you take in. So essentially, when people did this trade, buying it for 20 cents, they were buying it for they were risking $20, right? Because we multiply that by 100. They were risking $20 to make $480. And a lot of folks got that off. If you go back through and look at open interest on 90, 95, 100, you'll see a ton of open interest, particularly in January, because the initial thought off the CMA was that, hey, the FTC still has to say something. And by the way, they're very late in saying anything relative to what they should have said when the deal was announced, if they really had a problemo, right? So people were like, okay, if the FTC thing, if this goes to whatever, to another inning, the FTC may not be able to the FTC might not do anything. And so then it just is Microsoft versus the CMA, and whether or not they actually bother to pay the extension fee or whatever it is there. So that's the 20 cents. Yeah, it's a beautiful trade, Maximus. I'm going to assume that's what you meant. It can be quite a beautiful trade if folks can get it done, because they will have paid 20, risked $20, and will have made 480 for every structure that they did. Now, your broker will typically will typically either charge by the structure, rarely, but usually by the leg. So this is going to be three times the brokerage fee. So it might cost you $3 to do this trade. It might cost you more to do this trade, depending on what your broker's deal is. But that's the economics of this butterfly. Now the butterfly is already $1.23. I did a few at 40, full disclosure, and probably at 60 as well. You guys can check my Twitter, because every time I got a little excited on it, you could see I posted it. So if you follow me on Twitter, it's here. I'll undo this really quick so you guys can see. This is my Twitter. Sometimes I get really excited and I'll post the trade, but you can see where my trades are at. But as you can see, it's really in these last few days that you're starting to see the market maker market here at $1.20. And I think in some spots, you could do this all the way back. So you could have done the Januaries, which is what I'm showing. You could have done the March, the February, and even the December if you believe that this deal was closing. If you didn't think, or if you wanted to manage your risk associated with it not closing, that's a discussion that we'll have at the very end of this. But that's what people were doing. And you can see it very clearly if you just go through open interest and look at these strikes all the way back. Okay. So, oh, that's sweet, Maximus. Thank you in the comments. Okay. So then the second type of trade that a lot of folks, or that I started to do because I couldn't resist, is an iron butterfly. Iron butterflies don't happen, in my opinion, very often, or at least I personally don't see iron butterflies as often. But an iron butterfly in a lot of ways is a bit like the reverse of a butterfly as far as the economics go. Technically, it's an iron condor where the strikes on the short leg is the same. So an iron condor, if somebody was, I'm never the one to like make people get their jargon perfectly if I know what you mean. But an iron condor is when you have a credit put spread and a credit call spread. Okay. When you put those two together, what you're actually betting is not long or short. You're betting that it pins, that's the term, right at 95. So the bet is that, so another way to look at it is you have a straddle in the middle. So you're short the 95, long the 95. Why? Because the deal is done $95 in cash. And then so that you don't have to margin like crazy for these legs, you basically are long the 90s and long the 95s to hedge. Now, in this case, for whatever reason, because I definitely got some off, you were able to get them at $4.80. Now, your max gain on a 5-point iron butterfly, where the legs are the wings, they call them wings, but I sometimes call them legs. It doesn't matter what it is, legs or wings, whatever. Do you know what I mean? But if each of these is 5 points wide, then the max you can make is, again, $5 minus the premium. This is a credit spread. So you're short this, you would take in the premium, and the downside risk is that this whole thing doesn't happen. In other words, if this ends up closing on the expiration date, which here I'm showing you February. So if it ends up closing in February of 2024 below 90 or above 100, adjusting for the premium you're taking in, so it would be $90.20 below that, or $99.80. If it closes outside of this, like anywhere else, then this thing will lose money, but it will only lose $20. That's the max loss that you can make. Okay. So I did it because right now, occasionally it shows this way, $4.60. So in this case, your downside risk would be 40 cents. You would get to keep all of that credit, $4.60. And that's the economics. And then whatever your broker charges you to do this trade, which again is going to be 4 legs. So they're going to charge you for 4 legs. So in other words, this is a 10-for-1 payout. This is a very big payout. And so this came up, it's not there anymore. I'm just going to tell you, I mean, I have limit orders in like crazy. So I'm first in line, kids, for some of this. But right now, this thing is already widened to $1, to where you lose, your downside risk is $1, your upside is $4. And then whatever the broker is charging you to do the trade. And I hope that makes sense. But essentially, the whole point is you can do these all the way back on the expiration if you believe that the deal is done after the hearing. And again, just so you guys can see it, the hearing is, Microsoft says it will abandon Activision if the judge delays it. That's the statement that they made to the New York Times. And you can see it the specific words used that are quoted down below. Beth Wilkinson is the lead lawyer. And then up above, you can see what people are suggesting the timing in, which is they're going to hear it through this week. And the judge isn't expected to rule until after the July 4th holiday. And what's happening right now, it's being bid up because both the dynamic that I just mentioned, which is this statement that Beth Wilkinson made that she's out. She's outing 500 if it doesn't work. You know what I'm saying? So they'll just pay the $3 billion and move on, which changes the economics of what people were doing with the options. And also because the FTC isn't like a lot of folks are saying the FTC isn't doing a great job making its case. And there are other people that feel differently. You know, hey, not a lawyer, not trying to make a legal claim on this one. The folks that believe that the FTC is not making the claim, though, do have the movement of the stock in their favor. And also, there is a broker dealer, Needham, I think, upgraded it based on the fact that they didn't think that the FTC was doing a great job in the courtroom as well. So that's that. Okay, other things that I would just share. Yeah, I've already done all of that. Yeah. Okay, so warnings. If you were to do this trade even as a learning lesson, if you were like, hey, May, you know what? $100 to make $400 and I'm going to do it anyways and I won't come find you later getting all upset. I'm going to do this trade. A couple of things that you just need to be aware of. Number one, technically, if you should be able to do this even in a cash account because it is defined risk. Okay. So there's 500 max gain or loss. And so that would allow you to do it, I think. Okay. Because I'm not your broker dealer. Your broker dealer may have other rules. Number two, and this is really important, the spreads on the calls and the puts right now are really wide. And although your broker will do some things that are very unfair, one of the things it can do is, even though the max loss is in fact 500 minus the premium, they can mark this at $8. And they've done that to me a couple times this week. And I just put in an order that would reflect that I would be happy to buy an $8 account to offset it. I just put in a $5 order to try to stick it in the middle. But this thing can absolutely swing in a crazy way. And I just want to show you, just to give you a sense for how you can observe that cleanly. If you look at this is the February 24s. If you go into open interest, there's not that much open interest on the 95.90s. Nonetheless, I'm not playing it to trade out of it. I'm playing it for this thing to expire worthless, or I lose $20 and try to get out of it some other way. You know what I mean? In fairness, the financials of Activision suggest that if he gets the $3 billion, he could buy back stock and crush it that way. So it's really hard to know one way or the other. But if you look at how wide, $11 by $13.10, some people in the options market would think that's not wide, but that's wide enough for them to make this spread do crazy things. Same thing on the call side. You can see the 95s are trading, more than $1 wide, and the hundreds, which really should have very little left in them, are trading very strangely. So if you do this trade, just to have enough cash where you can manage marks, even if they're crazy. That's the first thing that I would warn you against. And then, yes, sometimes it's not obvious to people, but let me just say this. If no other person in any of your options training ever says this, anytime you take in a credit, you are short vol. So if vol increases, it does go against you. Now, technically, because you're long one leg and short the other, you'd think that you have actually hedged some of that volatility, and you would be wrong. And you'd be wrong because the volatility smile, which is a little bit of an advanced concept that I'm not going to go into aggressively here, for out of the money options, the smile can sometimes work against you, can sometimes work for you. I'll keep it that simple. So in fact, volatility shifts can absolutely change the economics of this. And then what I would finally show you, which I think is very, very prescient. I'm surprised I didn't use more of it. Here is options profit calculator. And you absolutely should use this, except when the liquidity is very poor, so too are the marks. So too is the data you'll get from options profit calculator. So you'll just have to go into the system and adjust the price per option. And it will give you the hockey stick chart, so you don't have to be too clever. It also gives you how things go at different theta decays, at different, so most of the theta decays you can see is going to be right up at the end. Okay. So that's kind of a thing to keep in mind. Yeah. And also it has this style chart, which I quite love, that shows you the payout, because like I said, if you take in $4.60 and your max gain and your max loss is that $40, most of this is going to be green for the entire period because you still are going to be able to keep some of that premium. That said, it might feel not as exciting in your portfolio. So quite frankly, if the deal breaks, I really have to think about whether I want to keep both legs of this trade. I might only lift one leg of the trade. And that's really it for this episode. I know that a lot of you guys aren't options folks that watch me, but I wanted to make this video. If you have questions later, feel free to put them in the comments. And hopefully that was interesting. You guys can watch the deal. And if there's no questions, thank you guys for tuning in. See you next time. Take care.